California's rental market is finally blinking, but not the way most people expected, with some cities cooling hard and others quietly heating back up in a north versus south showdown. From San Francisco to Bakersfield, from Sacramento to Los Angeles, this video jumps straight into the numbers to show where tenants are winning and where landlords are feeling the squeeze. Starting with NorCal. San Francisco's rental market in 2025-2026 has transitioned from shaky recovery to genuine stabilization. After several years of falling rents, from 2020's exodus to 2022's office-to-home reshuffle, the city began clawing its way back. By mid-2025, multiple analytics firms, including Zillow and Apartment List, reported rent growth between 8 and 11% year over year. That growth brought San Francisco's average one-bedroom rent to roughly $3,100 to $3,300, depending on the neighborhood, putting it back among the 5 most expensive markets in the U.S. Vacancy rates that had ballooned to near 10% during the pandemic tightened sharply. By early 2026, most data pointed to 3.5% to 5.5% vacancy, revealing a meaningful shift in landlord leverage. Popular districts such as Soma, Mission Bay, and Hayes Valley saw concessions fade as rental demand picked up not just from returning tech workers, but from biotech and AI sector expansions. While affordability remains a top concern, the key story for San Francisco is stability. After years of volatility, rents are moving predictably again, anchored by steady white-collar job growth and improved downtown vitality. Still, the market isn't homogeneous. Studio units and older buildings without renovation lag in performance, whereas renovated mid-market and Class A properties command faster lease-ups. Landlords have regained confidence, but they're cautious, keeping renewal hikes moderate to avoid scaring off newly committed tenants. Across the Bay, Oakland's rental recovery has been slower but more nuanced. After bottoming out between 2021 and 2023, the city began climbing modestly in 2025, with median rents ticking up roughly 4% year over year. By early 2026, the average one-bedroom hovered near $2,200, nearly back in line with pre-pandemic averages, but still noticeably cheaper than San Francisco's. Downtown Oakland remains the softest pocket due to higher vacancy and ongoing safety perceptions that limit demand. However, neighborhoods like Temescal, Rockridge, and Uptown show clear momentum, supported by improved commuter rail ridership and regional job recovery. Renters have choices, and landlords compete with tailored incentives. Think 1-month free deals or mid-term lease options to maintain occupancy. The takeaway? Oakland is a value alternative that's finding its footing again. It remains more negotiable than San Francisco, but average rents are firming. With tech spillover from Emeryville and returning hybrid workers commuting across the Bay Bridge again, the slow grind of stabilization looks sustainable through 2026. Sacramento's once booming rental market has entered a cooling cycle. Between 2020 and 2022, the region saw unprecedented rent hikes, some quarters jumping 15 to 20% annually as remote tech workers relocated inland. By mid-2024, however, that surge gave way to correction. According to Yardi Matrix and Rent Cafe, Sacramento's average asking rent slipped to around $1,850 to $1,900 in 2025, down roughly $400 from the pandemic peak. That doesn't mean a crash, just recalibration. Developers had rushed to meet pandemic-fueled demand, adding thousands of new mid-rise units near Midtown and Natomas. As population growth slowed and affordability in the Bay Area improved slightly, absorption lagged. Landlords today offer incentives like 2 free weeks of rent, reduced deposits, and discounted parking, particularly in newer Class A developments. Still, stable employment in state government, healthcare, and logistics continues to keep occupancy above 93%. Sacramento has matured into a steady mid-tier rental market, not cheap, but no longer overextended. Expect the market to hover flat through early 2026, setting up potential renewed growth once supply clears.
San Jose and its Silicon Valley neighbors now illustrate a post-boom equilibrium. Rents remain among the highest in the nation, yet they're not accelerating at tech cycle speed. By August 2025, Zillow estimated average rent at about $3,200, up modestly from 2024, but increasing only about 3% annually. Vacancy sits in the 4% to 6% range, well within normal bounds. The market's pace reflects a wider tech sector recalibration. AI startups have expanded hiring, but broader tech layoffs in 2023-2024 cooled household formation. Developers have adjusted to this reality, focusing on mixed-use and transit-oriented projects that can attract steady demand even in slower years. For renters, this environment provides balance. Units remain pricey, but abundant choices exist between similar luxury communities. For landlords, consistent though moderate rent growth safeguards long-term asset performance. In short, San Jose has shifted from frenzy to maturity, representing the stabilizing heart of Northern California's housing landscape. Los Angeles entered 2026 in a holding pattern. After dramatic rent gains through 2021-2022, average asking rent dropped slightly to about $2,700 to $2,725 according to RealPage and Zumper data. That's roughly 1% lower year over year, confirming that LA's market has finally cooled. Supply is the biggest new factor. Nearly 18,000 apartment units were delivered between 2024 and 2025, one of the largest bursts of new construction in a decade. Downtown LA, Koreatown, Hollywood, and the West Side all saw leasing competition intensify. As a result, tenants are regaining bargaining room, often securing small move-in bonuses, free months, or parking offers that were unthinkable 3 years ago. Still, LA's fundamentals remain strong. The entertainment and creative sectors are rebounding from strike-related slowdowns, and employers expanding hybrid work models mean steady baseline demand. Compared with 2020, average rents remain up more than 20%, emphasizing that this is a plateau, not a collapse. Submarkets tell a varied story. West Side and Santa Monica rents stay near record highs around $3,600 to $3,800 for a one-bedroom, while East LA suburbs display slower leasing velocity. Expect continued lateral movement, some micro-drops, some rebounds, but nothing suggesting large-scale distress. San Diego continues to live up to its reputation as a lifestyle premium market, highly desirable but increasingly expensive. By early 2026, the average rent sits near $2,750 to $2,800, roughly 1 to 2% lower than a year ago, according to Apartment List's December 2025 update. The flattening follows a steep climb between 2020 and 2023, when remote workers flooded coastal cities. Housing pipeline data shows that around 8,000 new units are entering the metro through 2026, especially in downtown and coastal corridors like Little Italy, Pacific Beach, and East Village. Those completions reintroduced competition among Class A operators, prompting mild concessions, think free gym memberships or limited short-term leases. Despite the overall slowdown, occupancy remains above 95%, and long-term prospects stay bullish given constrained land supply and strong biotech and defense employment. San Diego's rent moderation is best viewed as a normalization phase after a runaway 3-year period, not a downturn. For prospective renters, early 2026 presents an opening that might not last long once demand resumes in summer.
The Inland Empire, covering Riverside, Ontario, and San Bernardino, continues to hold firm as one of Southern California's most stable rental regions. Despite economic softening elsewhere, this area benefits from affordability migration. Households leaving Los Angeles find the Inland Empire's average rent of $2,000 to $2,050 far easier to manage. Even with some supply growth, vacancy remains contained, around 6.2% in early 2026, up slightly from 5% a year prior, according to CoStar. Rents still inch upward by 1% to 3% annually, outpacing inflation-adjusted declines seen in core Los Angeles. Developers note that Class B and workforce housing continue to outperform, while luxury units added in Rancho Cucamonga and Riverside proper face slower absorption. Employment diversity, logistics, healthcare, education, and distribution centers continues to stabilize local demand, and the region's light rail and freeway improvements reinforce its position as the attainable alternative for Southern California renters. Simply put, Inland Empire rents are cooling gently without losing their underlying strength. At the heart of California's Central Valley, Bakersfield remains an affordability anchor in the state's rental landscape. The city's average asking rent remains around $1,380 to $1,420 per Rent.com data, with vacancy just above 5%. In 2025, analysts noted a mild turning point. Rent growth slowed to near zero and even dipped by 0.5 to 1% in higher-end or newly built projects. However, this isn't market weakness so much as normalization after several years of outsized construction. Developers had pushed new supply during pandemic-era demand spikes, and by 2024-2025, absorption needed to catch up. That adjustment now shows through slightly higher vacancy and moderate incentives like half-off first month's rent. Still, Bakersfield continues attracting migrating tenants priced out of coastal metros. Its agricultural, energy, and logistics sectors keep local employment relatively steady. For investors, cap rates above 5% remain attractive compared with tight coastal markets. For renters, Bakersfield offers rare stability, low costs, moderate increases, and a pace of change that's far less volatile than the rest of California.
Santa Clarita, perched just north of Los Angeles, surged during the pandemic as families sought space, safety, and suburban comfort. That story has flattened by 2026. While the city retains one of LA County's highest median household incomes, rent trends have plateaued, matching countywide softness. ApperList's late 2025 data shows Metro LA's median rent slipping by about 1.3%, suggesting Santa Clarita is following the same pattern, steady, not crashing. Typical asking rents hover around $2,700 to $2,800, down just slightly from their 2023 peak. Larger three-bedroom suburban units, popular among families, are holding value best, while smaller apartments in newer complexes near Valencia have seen slower leasing and moderate incentives. Commuting patterns also influence this moderation. As office attendance requirements return in LA proper, longer highway commutes for Santa Clarita weigh on demand. Still, the area's school quality, safety metrics, and suburban amenities maintain strong fundamentals. The result, stabilization, not retreat, a balanced market where neither tenants nor landlords dominate negotiations.
Finally, we arrive in Long Beach, a coastal market at the intersection of affordability and urban growth. Long Beach's rental market mirrors much of LA County's, but with its own local flair. As of early 2026, average rents hover near $2,450, essentially flat year over year per CoStar data. The city's recent surge in waterfront and downtown development, mid-rise towers near Ocean Boulevard and Alamitos Beach, has expanded inventory significantly. Those new units compete fiercely, offering limited-time reductions or flexible leases to attract tenants, particularly younger professionals priced out of West LA. Crucially, Long Beach's port-driven economy and Cal State University influence keep rental demand diverse and durable. The city's market no longer behaves like the scarce supply, multiple bid frenzy of 2021-2022. Instead, it's entering what analysts call a steady equilibrium phase. Rents are high but predictable, and residents can finally shop around without losing their apartment in a single day. For renters, this means power shifting slightly back toward the tenant without erasing the city's price premium. For investors, Long Beach remains one of a few Southern California markets where new supply still pencils out, an appealing blend of stability and potential. From San Francisco to Bakersfield, California's rental market is clearly resetting unevenly, with some northern hubs tightening back up, while parts of Southern and Inland California finally lose a bit of their pricing power. If you enjoyed this breakdown, don't forget to like and subscribe so you never miss a California housing update.